Hi, welcome back to MBA Finance, Part 2. So today, this session, we're looking at financial planning. So let's get straight to it. Okay. Give me a second. Okay. Apologies for that. Let's continue. Okay. Okay. So looking at chapter 2 there. Financial planning. Look at the learning outcomes. You should be able to explain how businesses plans are developed and the role that projected financial statements play in this process. Prepare projected financial statements for business and interpret the significance for decision-making purposes. Discuss the strengths and weaknesses of each of the main methods for preparing projected financial statements and explain the ways in which projected financial statements may take account of risk and uncertainty. So steps in the planning process. So we set the aims and objectives. So every organization should have a mission. They should have a vision. And basically everything then should hang from the mission and the vision. So we set the aims and the objectives. We identify the options available. We select options and develop long-term plans. And we develop short-term plans. So we have our long-term plans, which will be where we make our investments, our business decisions. And then we have our shorter term plans, which will be day to day, week to week, and month to month for the coming 12 months. And part of the planning process is making decisions and identifying different options to solve a particular problem or different methods or options to maximize our stakeholder wealth. Projected financial statements normally comprise of our projected income statement or profit or loss, projected statement of financial position, a balance sheet, and a projected cash flow statement. So cash is king. We've got to guard and look after our cash. Otherwise, we will find ourselves or get ourselves into trouble. Preparing projected financial statements. So looking at the external variables, the rate of taxation will have impact. Interest rates for borrowings and the rate of inflation will all have impacts on our projected statements. Obviously, for the coming 12 months, the impact of inflation may not be so significant, but if we're projecting from, say, maybe years 2 to 5, then inflation will definitely have an impact. Preparing projected financial statements, looking at the internal variables, capital expenditure commitments. So how much capital commitments are we making currently? Looking at any financing agreements that we have, looking at any inventories, holding policies that we have, credit period allowed to our customers, because obviously that affects how quickly we can get money coming in from our customers, payment policies for trade payables, accounting policies, and any dividend policies. In an organization, when we have trade customers, normally we may give them, say, 30 days. But what we might do if we need to cash or if we're cash strapped, and we might say to our customers, pay within 10 days and we'll give you, say, like a 2% discount. Likewise, our suppliers will normally give us 30 days credit, but if they have cash flow issues, they may say to us, pay within 10 days and we give you a 2% discount. So if you are cash rich or healthy cash flow, it's always advisable to take the 2% discount because that's going to improve your underlying profits. But if you are, a little bit of cash strapped, then you might want to say, no, you know what, the 30 days credit is worth more to me than the 2% discount. Okay, so that's some of the decisions you need to make. Steps in preparing our projected financial statement. So we identified the key variables affecting the performance. So we have our aims, we have objectives, and then we're looking at the variables, okay, that's going to affect us. We prepare our sales forecast, which is the most important thing. And we prepare forecasts from the remaining elements of financial statements and prepare projected financial statements. So our income, whether it's public sector or private sector, is what really drives the agenda for the rest of the business and the rest of the statements. Okay, so obviously the higher the income coming in, then the money then will flow through from those actions and those decisions. Projected financial statements may cover short-term or long-term horizons. So short-term usually involves detailed forecasts of income, cash flows, and financial position. And long-term usually involves making and simplifying assumptions. So we've got to be able to, distinguish what we're doing here, short-term or longer term. Sources of cash flows, issue redemption of long-term funds, operating activities, tax and dividends, and purchase and sale of non-current assets. Okay, so that will be like our projects, our fixed assets. So this is kind of like, sources of our cash flows. Forecasting financial statements and decision making. So how were the projections developed? What underlying assumptions have been made and are they valid? And have all relevant items been included? So obviously when you make assumptions, all the assumptions do need to be tested and checked. Are the cash flows satisfactory? Can they be improved by changing policies or plans? Is there a need for additional financing? Is it feasible to obtain the amount required? Can any surplus funds be profitably reinvested elsewhere? And is the level of projected project satisfactory in relation to the risks involved? If not, what could be done to improve matters? So again, we're looking at our cash and we're looking at our profit. And always remember that profit does not always equal the same as cash, especially if we're dealing with credit. We're giving credit to our customers, taking credit from our suppliers, and also, non-cash items like depreciation, for example, or prepayments and accruals, okay, affect our profits, but not our cash. So again, it's important that we have a handle on that. Are the sales and individual expense items at a satisfactory level? Is the financial position at the end of the period acceptable? And is the level of borrowing acceptable? And is the business too dependent on borrowing? The higher the borrowing, by the way, the higher the risk that we have. Obviously, can we pay our debts? Can we pay our way? However, if leveraged right, and we put our borrowing into good projects, which will produce an income, a return investment, then we can pay back that money and retain some profits after all the hard work. Percent of sales methods. So when we're doing our forecasting, so we look at income statement, our expenses, our profit before tax, and then we talk about balance sheet, current assets that increase with sales, so inventories, receivables, current liabilities that increase with sales, cash, and non-current assets. So what we do, we take, say, our results for the last 3 to 5 years, we put a percentage of everything against sales. Then once we have our forecasted sales or money coming in, then basically the percentages fill in all the rest of the lines. So you can have a projected income statement and balance sheet, basically all done within 60 seconds based on your forecasted money coming in. That's one way to do it. Deducing the net cash flows from operations. So we take our operating profit plus depreciation expense, plus or minus, increase minus or decrease plus in inventories, or increase minus or decrease plus in trade receivables, increase or decrease in trade payables, interest paid, taxation paid, dividend paid, and we have our net cash flows from operating activities. So what we have is on our balance sheet, we'll have cash at bank. And what we've got to do, we've got to be able to look at our cash at the beginning of the year to our cash at the end of the year and be able to justify or be able to show, explain what the differences are. So the money's coming in, the money's going out. We also need to be able to show and demonstrate that from the profits or from the profits that we've made, okay, or the revenues coming in if you're public sector, how that has translated to the end of the year. Okay, so this method then shows you basically reconciliation between your profit and what closing cash you have in the bank. So that's quite important to know. And also, if I'm analyzing a business, I will know how they're getting their cash, how they're getting their cash, and what they're doing with their cash. So first thing we have to do then is translate our profit, okay, into what we call net cash flows from our profits. Okay, so what we do, we have to adjust for non-cash items, like depreciation is a non-cash item, but it affects our profit. So we add that back in. Then if we are putting money into inventories, yeah, then what we do, so think about it, if I'm putting money into inventories, that's taking my cash away. But if I'm reducing my inventories, I'm bringing cash into my business, okay? And same with debtors. If I'm increasing my debtors, yeah, then that's money going out. But if I'm decreasing my debtors, yeah, then that's money coming in. Same with creditors. If I'm increasing my creditors, that's actually taking like a loan, so it's kind of money coming in. And if I'm decreasing my creditors, I'm making payments, that's money going out. Okay, so it's a tool that helps us then to reconcile basically our profits to cash. Then what we're looking at is our risk. By the way, when we're looking at the cash flows as well, then we look at what we call our finance activities and what we call our investment activities. So we look at all the areas that are related to finance. So, you know, are we getting more loans, paying loans? And then the investments, are we selling our investments or are we buying new investments? Projected financial statements of risk, then looking at risk, so we can look at sensitivity analysis and scenario analysis, so we can look at the assumptions that we're making, and we can see how sensitive things are, say to an interest rate, and then we can do a little scenario analysis, so change different assumptions, change different areas, and see how that affects our results and if it's within our comfort zone. Okay, so that completes part 2 of our finance program. So it's important really to think about cash. Cash is king. Cash is what makes the business work. Cash is like blood in the blood to the organization. So we need to guard the cash. Cash doesn't always mean profit, or profit doesn't always mean cash. So again, we've got to make sure that when we managing our businesses, we're managing those cash items to ensure that we can, like blood for the human body, the business can rotate around. And it's important that we know how to forecast, how we need to look ahead and say, okay, this is our projections, this is when we may have a shortfall of cash, or this is where we may have an increase in cash for spare projects. So we need to be able to manage that process. So until we meet again, I'll see you soon.